Missed a bank deal and not sure why? Here's the hard truth. You were already too late. Top banks are quietly running tighter, more exclusive processes, only sharing deals with private equity firms that have done their pre-work on a deal and built relationships months in advance of launching the process. In today's episode, we sit down with Justin Smith, the Managing Director of Business Development at Agellus Capital, who's leading one of the most sophisticated intermediary-first sourcing functions in the middle market. Justin reveals the playbook behind Agellus's deal machine, from their 6+ active buy-side firms to the CRM fields they use to flag every missed opportunity, and how they're consistently winning in a hyper-competitive market. Today, we're covering why the best deals are locked up before the CIM even goes out and how to make sure you're on that short list, how Agellus uses Salesforce to track everything from lender insights to buy-side success rates, why top firms are investing in executive talent before the deal even closes, and how to stand out when everyone's showing up to the same conferences. If you're not already treating deal sourcing like your firm's primary competitive advantage, this episode is probably your wake-up call. Learn from a business development professional who's redefining winning in intermediary coverage. This is Deal Sourcery.
Justin, thanks so much for joining us. We're excited to talk about all things BD, Agellus, the new firm, and your background. But let's kick things off with a topic where I think you have a strong take. Is PE over enamored with proprietary deal flow?
It's a great question. I think they're over enamored with insourcing the proprietary deal flow engine. I think any fund should have an element of proprietary deal flow, specifically if you're doing buy and builds where you need to blend down that expensive platform multiple that you paid for your HVAC or your roofing company, what have you. But I think if you're doing that in-house, it's hard to scale. Think about a target list that you build that has 200 roofers on it. You're going to have to call those guys 20 times each just to get them to answer. And then when that conversation starts, how long is it to get a data request? How long is it to get clean financials? How long before they're really ready to sell? And so what I think works better instead of the insourcing of that, just due to the time constraints and the challenges to scale, are to do that with advisors, buy-side advisors. And at Agellus, we stand up a buy-side advisor for every platform we invest in, as well as theses that we've just developed that we're looking for targets for. And these guys are industry specialists. They're very good at pounding the phones and getting folks on, and they can run concurrent searches for you. They give you a much more efficient return of capital and time. So again, the proprietary deal sourcing, I think, is important, but I recommend outsourcing that just so you can get more flow, pre-qualified, knowing that you're going to have a low hit rate. And again, it takes a lot of work just to get one founder on the phone. So why not have someone who's specializing in that specific function do it for you?
So what does that mean? How many buy-side firms are you guys working with at any given time now then?
6 to 8. I think right now we have 3 on retainer. 2 are for each of our platforms, and they've done a great job. And then we have a couple that are success fee only. So you're not paying on the success. You're only paying if they close something. And those are a little higher on the back end, but they also come more qualified. And those are the ones that are doing work for new theses we have developed or sectors we don't have a platform. We're looking for something of a little more scale. So a little more finesse to that outreach. But I mean, at least a third of the inbound I get on email relating to deals every day is from buy-side groups. And they're pre-qualifying targets that may have an interest to sell. We're getting introduced to those founders, having conversations, and then taking the ball down the field. And to my earlier point, if you have 5 of those a week, maybe 1, if that, will ultimately be fruitful. But it's a great supplement to a pipeline, specifically if you're doing add-ons or starting smaller, right? Because at scale, you're competing against every investment bank out there. But it's worked really well for us today.
It's interesting. I imagine most folks are familiar with the buy-side space, right? But and my sense, at least my count today, is there's a couple hundred of these firms that are kind of doing buy-side work. But what for the folks that aren't maybe 100% familiar, like when you look at an engagement with a buy-side firm, where does that interaction start and where does it stop? Like what do you view as kind of the core set of things that a buy-side firm ends up doing when you're working with them?
They typically start in a market mapping phase. The bigger ones will do market mapping pro bono for you and help you understand the TAM, total addressable market, and the fragmentation in your sector. If you don't have that already figured out, they can help you there. And then you whittle down your filter criteria for what you would want for an add-on or a platform. We typically use them for add-ons. And then they'll build target lists, and you have weekly conversations once they reach out to those targets and find folks that are interested in talking to you directly. And so every week we're having conversations with each of our buy-side groups, if not more often than each week, learning about the targets they have in the pipeline and setting up times for calls with those founders. Once those founder calls happen, the buy-side group typically gets out of the way, and you work directly with the founder for data requests, in-person meetings, submitting LOIs, et cetera.
And not to, sorry, Matt, not to click too far into that for a minute, but like, you've obviously worked with a bunch of different buy-side firms today, and maybe I'm kind of jumping us a little bit forward here, but like, what does a good relationship there look like to you? And like, what are the best ones doing well from a buy-side perspective? And then what do you have to do well in order to make sure you've got like a really fruitful relationship there?
It's a great question. There's so many of them. We tend to lean on sector expertise. Certain folks are really good in resi services. Certain folks have a strong background and have done a lot of projects in white collar services. Some are T&L focused exclusively. So the ability to say more than just a canned intro to a founder on the phone, but the ability to develop instant rapport because you've worked with founders and sponsors in their sector in the past makes a buy-side group better than another for a given search. So that's one of the main things we look at is industry expertise. Can you get technical with a founder on the first call if they need you to?
So then that's what they need to do. But like, what's it look like for you, right? Like, because I know, it's important to like, they're handing it over to you at one point. Like, what do you have to do from that point forward?
The most important thing is for the buy-side group to be a good partner, you have to give them a clear mandate. You can't just say, hey, go find me a resi services company. A lot of sponsors do that, and they're kind of swimming in deep water. They don't know what they're doing. The more specific your search parameters are, the better the buy-side firm can work on your behalf. And you have to show well on those calls. When the buy-side the buy-side group passes off that founder to you, you have to show well, polite, professional, prepared, and have the conversation. I've heard stories from buy-side groups about how folks showed up to a meeting unprepared in a car, just not ready to have the meeting, and just that doesn't show well. So being prepared, being respectful, and knowing the sector and being able to speak to your expertise there is critical.
Yeah, it's interesting, right? I think one of the things to me that has been coming through as a trend through all the conversations that Matt and I have been having with folks, as well as the ones I kind of have one-off with firms, is that I guess just the realization in a lot of ways that investment professionals need to think of themselves like account executives, right? Where like you have to be able to actually carry the conversation forward and advance the ball when you're involved with anything that has to do with auction processes, right? And that includes with buy-side firms where like when you get an opportunity, you're sure that they've vetted the opportunity and sure you have some details on it, right? And sure they provide an introduction to you, but like now you're on, right? Like, and now it's your time. Like you've actually got to push the ball forward, advance the conversation, catalyze the transaction, build the relationship, like do all the things that like a traditional account executive might. And I mean, maybe I'm wrong about this, but my sense is like there's a lot of investment professionals and sourcing professionals in private equity firms today that either don't think that way or don't approach it that way. And that's where, at least in my experience, a lot of things kind of fall flat.
Totally agree. There's also a lot of ego. We tend to think highly of ourselves in private equity, and that's the quickest way for a deal to fail that's coming from a buy-side advisor. Well, our first call with a buy-side advisor is typically myself along with one of the partners. The partners will lead the call, and they talk 20% of the time. You're asking questions, showing interest in that founder, and then answer the questions they give you. What you don't want to do is start with a 20-minute soliloquy on why you're great and the history of your fund and all the cool deals you've done. So the culture piece and relatability is 80% of the first call. From there, if you've shown that you're a nice, normal person who obviously has capital and some expertise in their sector, then you can move the ball down the field. But it all starts with the simple stuff that most people would say is easy to do. Just be nice and relatable.
Well, it's interesting, right? I think it's easy to forget people want to do business with the people they like. And it's like we live in this universe not only of the B2B world, but in like private equity deal sourcing, right? And like I think it's easy to kind of think, well, yeah, it's just like the numbers and like the key metrics and the deal that's on the table that really matters. And it's like, no, the first thing that actually matters is like they gotta like you.
Yes, 100%. And we're playing from behind because of the stigma of our industry, right? So, especially if you're reaching out to some Midwestern business owner, humble roots, built his business or her business from scratch, and now the big bad private equity firms calling. How do you get out in front of that stigma to show, no, I'm actually normal. I'm actually okay to do business with.
How do you message that? Like when you walk into a conversation, right? Like what are the set of things that you're like, I got to make sure I'm delivering on this point? Like, I don't know, like, do you have keys for like, as you think about messaging when you're kind of walking into a conversation like that?
Yeah, the first thing we want to say is how thankful and appreciative we are to be talking to them. We're impressed with what they've done with their business based on what we know about it. We do have some experience in the sector, and here's what we've done. And tell that story. And then there's instant rapport and credibility. And then just asking them a lot about themselves and about their business and what they think it took to get them to that level. And then what they're looking for as a next step. What are the holes in your business? What do you think you would do if you were recapitalized? Tell us about your management team. Tell us about the growth opportunities you want to pursue. And again, it's asking the right questions and then letting the answers come to you from that founder on the first call.
I was actually reflecting on this over the weekend, right? And I was trying to think about, gosh, over a decade of deal sourcing, like what's been my value, what's been my messaging, like what's been the process that I've actually taken that's allowed me to kind of break through with a lot of founders, right? And I started kind of having this realization that like one of the first things I'm going to your point is that relatability piece, right? Like first is break the ice. It's some sort of relatability. It's some sort of like commonalities that we have, right? Like whether that's time we spent in the industry, what we know about their industry, what we think we know about them, like the personal connection piece of it. Both like outdoor activities, what if both have family and kids, like whatever those kind of relatability things are. But then I realized one of the things that I always would do, like I think exactly like you're talking about, is I would ask for their story. Right. I would say, and it came genuinely from a place of curiosity, right? Of like, hey, how did you like, this is so cool what you guys have built, like, how'd you start? How'd you get into this? Right. And like, let them tell that story. And then when they kind of get through that story, the thing that I realized is, well, what you're actually doing is you're kind of connecting this straight line between their past and their future. And the thing to me that was one of the biggest unlocks, I don't know if this has been your experience. I'd love to hear how you've approached this, but the thing that was a big unlock to me was getting them to talk about their dreams and their ambitions and their aspirations, like the things that they want to accomplish, right? So now you're drawing this connection between where'd you start this and where's it going? And once you unlock, at least my experience is once you unlock that, what do they want? What do they want to achieve? What are their business goals, dreams, and aspirations? Because the funny thing is, to me, I feel like a lot of founders don't have good places to talk about those things, good avenues, for having those conversations. But if you can make yourself that shoulder for that conversation and open it up, and then also, to an extent, be somebody that can kind of help solve some of that to me ended up, like, as I thought about it over the weekend, is like kind of a big part of the unlock.
100%. And for us, the founders whose dreams involve staying on with the company, rolling equity, and being part of something massive in 5 years are the ones that we have the most resonance with, because that's the story we tell the best. Jeff and Bo, our co-founders, have a history of doing buy and builds at their prior funds and some great stories to tell. Jeff did Lynn the Plumber, one of the best, but it's like a Harvard case study for a Resi Services roll-up. It's probably the largest plumber in the Mid-Atlantic area, Baltimore-based plumber that he did a roll-up with while at Thompson Street. Great success story there. That founder, Lynn Bush, is now in our fund as an investor. Another roll-up that Jeff did was one in the fire and life safety sector here in Missouri several years ago called Marmac Fire. That founder is also an investor in our fund. It's since traded twice from Thompson Street to HGGC, and now KKR is the owner. So when you can tell those success stories and tell those founders, hey, if you want to stay on, continue to lead your business and help us guide you to more growth, we can take this thing to the moon and give examples of how we've done it in the past. And that's the future piece you're talking about. Here's what it can look like.
And here's how we can help you get there.
Sure, it goes a long way. I wanted to, I think, Justin, you have a really interesting perspective that will resonate with what I imagine are a lot of our listeners that are either stepping into sort of lead BD roles or considering it and wondering what to do, how to get started. So you've done that 3 times at 3 different firms, as I understand it. You have a new firm, you have a new fund, ready to deploy. What do you do? What are those first steps?
First step is important. It's the infrastructure build, right? What comes out of all the conversations you have at conferences and Teams calls and road shows? It's data, right? It's not only deals, but it's, this company is doing this deal. We pitched that and lost it, and those guys won it. We're bringing this one out. It's this size of this profile. How well can you capture all that data and then report around it, analyze it, let that inform future decision making? That is the infrastructure that you need at day one to start building. So what does the infrastructure look like? CRM, right? We use Salesforce. I could talk on a whole nother podcast about the value of Salesforce and how it integrates across multiple functional areas within private equity. You need a good M&A database so you can track companies. Grata, Source Scrub, Sutton Place Strategies is ours. You need a good old-fashioned MailChimp or email marketing campaign. You need to be talking to the market when you're doing deals, when you're building the team, when you're raising money, selling companies. If you're not talking to the market, they're not going to know what's happening. And the more you talk to the market with insightful, interesting content, they'll talk back and deal flow will come in. Same thing with social media on LinkedIn. I'm a big fan of using LinkedIn to promote what you're doing. You guys do that great on your end as well. Very important tool. And I'll stop right there and just say, you don't have to have a 20 tech deep stack. 3 or 4 things that you're really deep on and using well that are all integrated can get the job done. So don't index on the quantity of tech would be my advice to a new group, but focus on 2 or 3 things where you can get really deep and customize those platforms to your own business needs.
You seem to mention that you're using Salesforce to capture more than just the standard, Grata or Source Scrub exports. Like, is that, if you guys have custom objects in there? Have you built like other sorts of things that you guys are tracking? Like, what is it? What are the sets of data that you're talking about that you guys are tracking?
Yeah. So every conversation we have gets logged in Salesforce. If it's relevant to one or more platforms of Theses, then it gets tagged. So that's every conversation. And we track how long it's been since I've talked to XYZ banker in XYZ region or an XYZ vertical. We obviously track all the deals that come in and all the metrics around those and report around them. We have a talent module. So any executive that we're interested in to be at one of our platforms gets tagged in Salesforce and linked to a portco with his or her skill set and all the details around conversations that have been had with that person. Lenders, same thing. All these lenders are reaching out. There's valuable relationships to be had there, not only from a financing standpoint, but from a market intel standpoint. Some of the best intel I've gotten on deals that we want or don't want have come from lenders. So we tag them in there and their parameters for sourcing and who they've worked with, et cetera. And the list can go on and on. There's also third-party service providers that you need for various pre or post-close diligence that have different strengths and capabilities. You tag that stuff in there. So we have a kind of a multi-pronged set of modules in Salesforce that the whole team uses that really makes for efficient work days.
It seems like there's a lot of different pieces, multi-pronged approach. If you had to boil it down, are there key metrics that guide you?
We track conversations. How many conversations are you having? We track deal flow. What deals are we seeing? What deals are we not seeing? Right? And we have what we call our house accounts. Now, for middle market groups or groups that have larger funds that are chasing more auction deals, you have to make sure you're keeping score with these banks. We're spending a lot of time traveling to them, talking about the deals we're looking to get, learning about the deals they just closed. How many deals are we seeing from them that are relevant? So we have Sutton Place Strategies, which is an M&A database that was previously owned, I think still owned by Bain. Really cool. Shows all the deals that are happening in market. in your target verticals. That's integrated with Salesforce that shows all the deals we've seen, and we net those out. And when you can say, okay, what deals did Citizens do that we didn't see? Or what are the deals that Houlihan did that we didn't see that we should have in environmental services or outsourced legal or whatever? And then you take that each week and you look at it and you make phone calls and you do outreach based on the deals you didn't see. And you'd be shocked. You never don't see a deal a second time. They know to send you the next one. And so that's just an example of how the tech talks to each other to help you plan out your outreach.
Is that mostly like when you think about identifying, like, hey, I just saw Houlihan did this deal. It's in my space. It was a, fire and life safety deal, right? And so like we should have seen that. Why didn't we see? Like, is that the conversation, or like what? How do you approach those conversations when you're reaching out to them?
It depends on how well I know the sponsor coverage person or the banker. Typically, it's like, look, this is a space we're spending a lot of time in. Here's an example. We bid on XYZ business, this one, that one. They're going to know the businesses. It's all the same companies. So you can speak to your expertise in it briefly. We like the space. We're spending time here. We own this business. It would be a great tuck in. Would love to get a debrief from your industry team on this. And so that's the goal, is trying to get to the industry bankers who are the ultimate decision makers when it comes to the buyer lists, and make sure that you're registering interest in that sector with them. In a perfect world, I would have done that already, but there's only one of me. And so on a weekly basis, I will find a deal that I would have loved to have seen that we missed. And so then you reach out to that banker, get a debrief call on the books, and you'll get the next one.
Do you target kind of going after bankers of a certain size, or banks of a certain size, or like, because I know there's too many bankers in the world to cover. Like, how do you make that determination of like these are the ones I'm going to spend time with, and these are the ones that I'm not?
It's a great question, and we have a unique challenge here at Agellus because we have wide parameters for the deals we'll do. 2 to 20 of EBITDA is our range. Ideally, if we do our jobs, we're growing those companies to 30, 40, 50. So that's 3 different cohorts of investment banks. You've got lower middle market banks doing $5-6 million EBITDA deals we have to stay in front of. And you have the middle market banks, the Houlihans, Lincolns, Harris Williams. They're doing, $10 to $20 million EBITDA deals, sometimes bigger. And then you have your Jefferies, your Lazards, your true upper middle markets that if we do our jobs well, we're using them to sell because they're selling into the large cap sponsor universe. So I have to cover all 3. And the answer, Dan, is it's all by industry specialization. Like, I'm talking to IT services bankers every week because we have a platform there that we're building. I'm talking to blue collar facility services bankers every week at banks, from the tiny boutiques to the true middle markets to the upper middle market.
So folks that have done a deal in the space, right?
Folks that have done deals in the space are the most relevant, or that are tracking the space or trying to do deals in the space. And if you do it all comes together, right? If you do a good job with your PR and your outreach, whether it's your announcing platforms you've done, or if I'm blasting 15,000 people with an email blast saying, Agellus seeks restoration services businesses, the inbound will come, and then you can have those conversations and build out the network for that specific vertical.
It makes a ton of sense. And you're tracking most of that SPS, right? You kind of say like, hey, dude, who did a deal in this space? Who did a deal in my space? Like, I'm going to be in front of them. And it sounds like using those metrics to also identify who you're spending the most time with. I'm curious, do you look at like some of those equivalents on the buy side of the equation as well, in terms of like tracking people by metrics, deals they did in the space to kind of say, oh gosh, these are the buy side firms I really need to be working with?
We do. Admittedly, the structure on that is not as automated as I'd like it to be, as it is on the sell side. But we know the buy side groups. We get a lot of intel from buy side groups, and we talk to them about the deals they're doing with our competitors. And sometimes we'll sign agreements for fallout. We have a fire and life safety platform. There are many groups that are doing fire and life safety roll-ups. We know the buy side advisors that are representing those folks. We talk to them. And if XYZ company passes on a $2 million EBITDA business in LA, maybe we can get that one. So I think that's an important relationship to maintain as well with those guys for those reasons.
I heard an interesting tactic on this last week. I was talking to somebody there saying, well, what we do is, and maybe they hate me for saying this, I don't know, but what we do is we actually pay a small retainer to the ones that are really doing stuff in our space that's with one of our competitors to make sure we see the second one, second pass on anything they pass on. So while we don't have them on a full retainer for doing a dedicated search, if I've seen they've done a bunch of deals in my space, I throw them a little monthly bone and I make sure I get second pass on everything.
That's brilliant. I love that idea. And I can think of 3 firms off the top of my head that we should be doing that with.
So if we look at maybe the first thing that you focus on as you step into a new role as a BD person, leading the function, putting the infrastructure in place is key. So you have your CRM, you have your kind of data sources. What's next? Once you feel like you have that in place, if you could kind of form the framework or give us the framework for folks that are maybe entering a position like this, because it's a really common search for us, is first time hire at a firm that hasn't had BD before. And so they have a sales force, they obviously have relationships. But what's that next piece after you get the infrastructure in place?
I'll just say as a disclaimer, your BD efforts will only be as fruitful as your thesis is sound, right? So if you have a good investment thesis as a fund, presumably you do, you've raised money and you know what verticals you're targeting. Step 1 after the infrastructure is find out who are the bankers and brokers doing deals in my space. That's crucial. And map that out. Coast to coast, whatever your verticals are, whatever your sub verticals, you can find through these M&A databases and through the tech stack you've now built, who are the folks doing deals in my sectors, and get on the phone with them. Hit the road, go to the conferences. I'm at every conference, it's tiresome work, but it's fruitful work, because nothing builds a relationship or makes you more memorable than sharing a coffee or a beer with someone on the road in Vegas or Boston or Scottsdale. So market map the bankers, get in front of them, let them know this is our sector of interest, this is why, and you'll start to see the deal flow come in from those folks.
Yeah, it's interesting. You mentioned a point of kind of getting on the road, right? And it's a lot of people I talk to, I'm like, that's my number one point of emphasis of probably the most underrated and underutilized thing today is like, get on the road, get in front of them in person, right? Happen to be places, happen to be wherever they are, right? Because that at least my experience is like building that human to human relationship. It's one thing to do it on a Zoom call, but you do it in person and you pretty quickly have the ability to stick in the back of their mind as a real human being. And I don't know if that's because there's more information that's actually translated in terms of, bits and bytes when you're in person versus through a video screen, right? And like all the, other subtle kind of human cues and everything else like that. But gosh, I just always felt like the quality and the depth of the relationship you get from that in-person meeting is, I wish I could measure it, but probably orders of magnitude, stronger than doing a video call.
100%. And that's why the conference scene is so valuable. But the sad thing is, Dan, is that the secret's out. These conferences are jam-packed.
Well, what kind of conferences though, right? Like, are we talking, ACG conferences, or are we talking industry conferences?
Both. Banker-led, banker-hosted conferences, ACG and M&A conferences, and then the industry conferences, which candidly, I'll be doing more of this year than I did last year. So I can't speak with as much authority on the industry conferences. But for example, I went to, I think, 16 conferences last year, mostly M&A and banker hosted. And I got waitlisted for M&A East in Philly, which I'm still upset about. But it just speaks to the amount of volume out there for folks out there chasing deals, right? There's so much more dollars available to chase deals than there are deals to be chased in this market. And you guys have read all the headlines around the kind of the macro conditions that created that everyone's on the road, everyone's trying to talk to your banker, everyone's in the ACG portal trying to schedule a meeting at the same time you are. And it creates a whole other dynamic around how do you out hustle the competition? Once you have a sound playbook, how do I execute it in a way that allows me to get there first and get the meeting or just see the deal, much less be able to bid on it, right? So it's a whole other layer of competition that's new to this market over the last couple of years, at least from my perspective.
So what's the better play today? I mean, because if everybody's showing up to those same conferences, like, is there a different angle to play today?
It's a great question. The angle that I would play, kind of the ace, is just do a road show. Say, go to Cleveland for a week and go talk to the 5 or 10 Cleveland banks and say, hey, I'm going to be in Cleveland. I'd love to meet with you, right? That is the ultimate. If a banker's going to host you in their office, they know you're really serious. You come prepared. you meet with 3 or 4 industry bankers at the same time, they will not forget you. The next best thing would be meeting them at a conference, meeting them over a dinner or drinks. And then obviously at the other end is the Zoom call, which it's better than nothing, but you can get a roadshow on the books. Nothing beats it.
Yeah, I'm with it. I would just always call those kind of city trips, right, or regional trips, whatever you want to call them. But it's like, hey, just make an excuse to be in a place, set up as many meetings as you can, right? And then you're not just kind of competing with everybody else at that conference, right?
Happen to be places more is one of my favorite Dan Herr lines.
Yeah, it's great. And, and you can even do it if you're really aggressive. You can do it adjacent to a conference, right? Because who are typically at the conferences? Generally not the person leading the deal that you want to win. They're important relationships to have. And I want as many friends at Houlihan and Lincoln and Harris Williams as I can get. But if I want to talk to the industry banker that just sold that environmental services deal that I never got to see, but wanted to, that person's probably at their desk working on the next one during the ACG conference. So if I'm at ACG Chicago, let me spend an extra day to go hit them up and a few other banks in their office.
I'm curious, how do you end up tiering bankers, right? Or breaking them up or bucketing them, right? Like I imagine you have kind of like, here's my top tier banker. Like what's your rating system for breaking them down?
Yeah. So it's kind of subjective. We have house accounts. We'll have a couple thousand conversations a year with, several hundred different banks, but we have our top 30 to 40 that we call house accounts that are large banks that have different specializations. Different industry subsets.
So does house account, that's a label on a bank itself where you're like this. So how many house accounts would there be at a time?
Right now we have about 30, but that's going to grow. And it's a function of how many banks are doing deal flow consistently in our target verticals, right? So there could be boutiques like, Republic Partners is a boutique TNL investment bank out of Chicago. They're not doing 50 deals a year, but they're doing 5 to 10 that are really valuable for us. Or it could be, a Jeggy who's in New York and they're doing outsourced legal, kind of leaders in that market. So those are regionals, but they're doing a lot of deal flow in our target verticals. Generally speaking, it's the big ones I keep mentioning. So like all the Harris Williams, Lincoln, Houlihan, Ray J, finding out the bankers there that are doing deals in our verticals. And those are the ones that we call house accounts and staying on top of them almost monthly.
So that's okay, interesting. Because I was going to ask that next question. One of the things when you think about like sales and marketing best practices, one of the things you typically do is you have what's called these SLAs, right? You say, like, here's our service level agreements, here's our expectation, our standard of excellence for those house accounts. So like, what is that overall standard of excellence for house accounts? It sounds like part of that is engage them monthly, but is there a set of things you expect to make sure you do with your house accounts?
We have to stay in touch with the industry bankers that are in our target verticals regularly. Get in front of every deal they're doing. And by in front, I mean 3 to 6 month head start. Like if they're pitching a deal, I want to learn about it. If they lost the pitch, who else was there? I'm going to go talk to them. Why did you turn down the mandate, or why did you lose the pitch? Did you win it? When's it coming out? Tell me about it. Oh, by the way, we really like this. Can we talk to management before you launch? Right? That takes time to build a relationship of that level. But if you have that cadence of conversation and you're there in person, then you can get to that point with these groups to the point where we call it an advantaged auction. It's like a field label in our Salesforce CRM versus a relative auction.
So what qualifies something as having reached that stage of advantage auction, right? Does that mean you've met with the management team or the ownership in advance of the process, or like what allows that label to exist?
We're getting a head start on the deal courtesy of the bank. We're getting inside information, early access to the MP to the management team, or there's a storied history with that bank or that banker that we know we're going to get a favor, we're going to get the last look, even though it's not explicitly stated.
Really interesting, man. That's right. So as we think about what's behind house accounts, like are there other buckets, or is it just like house account or not house account?
It's a great question, and I'm embarrassed to say there's nothing behind it yet, but there will be. I mean, that's the reality. It's kind of the model that we use right now. I'm a proponent of it, which is spend 80% of your time with the top 20 to 30% of the most valuable relationships. And then don't neglect the rest of the folks, but just make sure that 80% of your time's focused there, right? And after you've been doing it for a while, specifically with a sector focus and theses that are pretty well defined, it's the same cast of characters. And spoiler alert, a lot of other funds are doing the same thing. So if I don't spend enough time with them, someone else will come in and they'll have their own advantaged auction on that deal. So it's hyper competitive right now. We could talk about deals we've missed out on that. I mean, I'll give you an example. There was a bank I met with last summer in Chicago, previewed a really attractive asset, environmental services. We flagged it, we tagged it, we got ready. We found out it was in market 6 months later. I reached out to the sponsor coverage rep there and said, hey, why aren't we seeing this? We talked about this. It's right down the fairway for us. He's like, can't let you in. I'm like, why? He says, well, there's only 10 groups that get to see this deal, and they've been digging in for 3 to 6 months. They're all billion-dollar funds. They either have an asset in the space or have really leaned in on the sector recently. Those groups beat us. They got to the punch first. They did their homework, and I didn't get to see that deal. And so on the next one, you learn, okay, let me get in front of that. Let me make sure that we're registering strong interest 3 to 5 months or 6 months before launch to make sure I'm on the list for the next one.
That's crazy. So that's where we're at now.
That's where we're at. And it's happening all the time. Banks are running narrower processes for a slew of reasons. One, they just don't have the time to host 10 MPs and manage 50 IOIs. But also, there's still a lot of heartburn from the post-COVID days. 23 was a rocky year. A lot of processes busted in the 7th or 8th inning. And if you're a banker, that looks really bad. So how do you prevent that? You cull your list. And you make sure that you're going to send this to folks that are qualified. They're not going to mess around. They already know the sector.
Yeah, but it's not even just like a cull it down to a fireside chat sort of thing. Like what we're talking about now is we're saying like, I'm only going to work with the firms that have done pre-work before we even launch the auction.
Yeah. And those firms, even though there's only 10 of them, will bid each other up and get the ultimate outcome. But you save a lot of time and you concentrate your efforts. And it's kind of, they view it as a win-win. The founder's time is protected. The conversations are easier to have. The diligence is easier because those groups know it. And that's just a function of there being so many private equity firms now. And I'll bring it all back to thesis development, right? If it's specific environmental services, there's 10, 20 groups that do that really, really well. And so those bankers know those guys and they're going to get the first look. So when you have that thesis lined up, you got to scream it to the market so you can get that phone call too, because less calls are going out, specifically for scaled assets in banked auctions, right? This is a subset of the market that's not applicable everywhere, but it's real.
What's enough pre-work to have done before an auction now then?
You've either accessed or paid for a market study. You've done full thesis work. That's like, 6 to 9 months of work at the firm level that's pretty collaborative and programmatic, where you have an idea and then spend 6 to 8 months trying to find out why it's a bad idea. And if you can't figure out why it's a bad idea after 6 to 8 months, it's probably a good idea. You talk to lenders, bankers, other sponsors. You get executives lined up who have worked in the space. And once you've checked all those boxes and your thesis is sound, then you can tell that story to a banker and show them the work you've done, reference deals that they did or other groups have done, ask intelligent questions. What are the value drivers in this sector? We saw this business traded at this multiple. You think this one's going to trade at that multiple. Why? And then it's a very much more informed conversation where you impress upon that banker, hey, okay, these guys are ready to play in this sector. They're not going to waste my time.
And if you haven't done that pre-work today, it sounds like you're substantially behind the curve.
There's a lot of emphasis on thesis development. I want to talk more about that. But just as we're, this kind of second piece of the overall structure within the BD function, you've got infrastructure first, and then you've got relationships. What was it like being a brand new firm? What was the reception in the market? Did that add like an added level of difficulty, or was it enough to have, founders from reputable firms, your kind of career and relationships that you're bringing in? I'm curious because again, kind of tying to folks that are, entering this type of role at a new firm, what should they expect?
Great question. When you're a new fund, all you have is the reputation of yourself and the founders. And we're really lucky here at Agellus. I was really lucky. I joined on day one, pre-fundraise, not even pre-fund deployment, but all we had to go on was the relationship and the history of the founders. Both founders came from Audax Private Equity in Boston. One was a lifer there who did 15 years, Bo Thomas. The other, Jeff Aiello, started his career there, then migrated over to Thompson Street Capital here in St. Louis. Both have a great track record of buy and builds across business services, blue and white collar, resi services, and T&L. So what we said to the market was, here's what we've done. We're going to do this exact thing with more focused at a smaller starting point. Here's our pitch. And it worked. We raised $400 million in 4.5 months with about a dozen LPs. And we're very well received in market because of the success of that raise and the relationships that the founders had in the broader market with bankers, lenders, LPs, et cetera. So the better your relationships are, legacy relationships that the partners hold, the smoother it'll be launching. And that was what really helped us out.
So there's a lot of emphasis on the thesis, and I think it's interesting to see the different degrees that BD professionals are involved, throughout the deal process. But maybe just honing in on the thesis development, what does it look like when it's done right, and how involved should a BD professional be? Great
question. I'll start by saying one of the biggest misnomers about thesis development, I think, in private equity is that you need to be the first one with that idea. In fact, that can also be more of a problem than it is an advantage, right? Be the second, third, or fourth to do the roll-up in HVAC services or landscaping, right? Or roofing, because you can learn from what the other folks have done ahead of you, what they got right and wrong. Where does BD come in? When there's folks that are doing a thesis that's early innings, it's just off the ground. It's a new sector folks are rolling up. You go to those sponsors on the road when you're at conferences that are invested in that sector. You go to the bankers that have led the deals there and you pick their brains, and you'd be surprised. You'll get a lot of great feedback, and that helps build the thesis. So the BD person's role in thesis development is market outreach to gather intel from the buy side and the sell side.
Yeah, it's interesting. I was actually having this conversation this last week with actually a handful of my advisors from business I'm building. But one of the points that came out of it, which resonated really well, exactly to this point we're talking about, is anytime you're trying to figure out, this was the quote, was anytime you're trying to figure out what or how, right, you should probably be thinking about who. That quote kind of stuck with me this last week because it took me back to spending time in the seat at Sarent, right? And one of the big things to me was always about figuring out who are the people that can help me solve the problem, right? And who are the people that can help me get a perspective on the market. And as I think back on it, like a big chunk, a majority of deals that I've done have been a factor of the people I've surrounded myself with and the knowledge that they've brought to the table more so than anything I have necessarily myself. And so I found it interesting to kind of think of myself as to your point, Justin, like that aggregator of knowledge, right? Where you don't have to know everything, but what you got to do is you got to be resourceful in a way where you can find that knowledge and build those connections around you such that you have, all the arrows in your quiver to be successful. And to me, one of the ways I think about that is not just in bankers, to the point you mentioned, which is like having the bankers there, which I think is very important. But I think one of the most underrated ones is in having like what I'd call your, industry executives or river guys or whatever operating, whatever you want to call them. But like the folks that in particular to me are the ones that have kind of been there before. Like we had this saying that was actually in my high school. I remember, by our basketball gym, and every time I was kind of coming back from practice, it was like, to know the way ahead, ask those coming back. Right. And it's such kind of salient advice, right? Especially as it relates to like our profession and sourcing. And to me, like kind of surrounding yourselves with the people that have been there and done that and have that be truly what you need in order to get to success.
I totally agree. I think that's our job in BD, is just to collaborate, build relationships, and gather market intel, right? And so the more folks you can learn from, that's the mentality, right? You're learning something on every call. Like I said earlier, a lot of folks will go to conferences and avoid lenders. I'll talk to all the lenders because they're seeing all the deals. They can tell you the value drivers and why this one traded high or low. In addition to being financing partners, there's a benefit to that market intel. And so the more conversations you can have, the more folks you can bring into the tent to collaborate on thesis building and other exercises, I think the better, the more the firm benefits.
What are all those buckets, right? Like when you think about the different types of people that you need to surround yourself with, right? Like we talked about the bankers. I'm talking about some of these industry execs. I don't know, like how would you paint out the different buckets? You're like, all right, well, let me surround myself with everybody. Like, what are the different buckets you're going to look in?
Sell side brokers, bankers, sell side brokers, doing smaller deals, buy side brokers who are doing market mapping and target outreach for add-ons, right? That we've talked about earlier. And lenders would be the primary ones. LPs obviously are important too. They're the ones that make it all happen. I would say those are the 5 primary buckets.
Interesting. So you don't end up targeting like,
oh, I left out founders, executives. That's where you were going, right? Those may be the most important. We won't do a new platform without a founder in place. If we don't think that the executive team at XYZ company that we're bidding on an auction is the right pro forma executive team to scale that business from 10 to 30 or 40 EBITDA, we won't do the deal. To your point, you have to have an executive team in place. So it's something we spend a lot of time on. It's something I need to be spending more time on, frankly, is the executive relationship build out, because without a solid C-suite, none of it can happen.
And you said executives plural. Is that like, do you think about for every potential new portfolio company, is there like a handful of different seats that you feel like you need to have for each one?
Totally. 3 to be precise. We typically do a holdco structure when we buy a new platform. There are exceptions to this. For example, in the case that the platform has an exceptional management team and we don't need to augment it, and we feel like that team can go from 8 to 10 to 50, then we'll keep it there. But for the most part, we will build a holdco structure that has a holdco CEO, CFO, and head of corp dev that works with that management team throughout the hold to optimize, do process improvement, help with integration of add-ons, give them the internal capability to be a self-sustaining machine on margin expansion, process improvement, integration, so that when we go to sell that business, it runs itself. And people don't look and say, oh, okay, that growth is only attributable to Agellus' team. It's not attributable to the management team.
What are the profiles of those folks, right? Like, are you looking, is it like exited founder? Like, I don't know, like for those 3 positions you're mentioning.
It's simple. If we want to scale to 40, 50 of EBITDA, we need a management team that has the chops that's already done it. They need to know what it looks like to run a $40 million EBITDA company in that sector. If you don't, then that's a huge risk. Because as you know, 5 to 10 to 40, those are 3 different businesses. So making sure that the management team has been there and done that and has a playbook they've executed in the past to help get you to that finish line.
Including the corp dev person.
Yes. Over time, you want to integrate corp dev into the portfolio. When you go to sell, you want all that M&A to be attributable to the management team in-house. So that's a pivotal role where they're helping build out that capability internally so that the management team can self-sustain with their target outreach, diligence, and closing of all those add-ons. But yeah, all 3 of those need to be folks that know what the finish line looks like on day one.
Awesome. Switching gears here a bit, I want to talk a bit about your career path in BD. You've been in the role for some time now and in different places, and I think it'll be interesting perspective. So how did you originally break in, and then a little background story there, and then now that you've kind of come up within the function, MD and head of BD, what advice would you give folks looking to do the same? And not necessarily how to break in, but how do you go from BD associate VP to leading the function?
Sure. So on myself, my private equity career started in Dallas in 2010 as an intern for a fund out there called Transition Capital Partners. And I'll never forget, I showed up on day one with my laptop and my finance textbook. And I was like, okay, you're going to go be a finance bro and crank out some LBO models. And the partner looked at me and said, here's some white pages. Here's a laptop. Go call all these banks and tell them what we do and find us some deals. And I was scratching my head. And that was BD before BD was cool. Like that was 2010. Fast forward to today. Like I said, I've now been able to build out a function at 3 different funds. From Transition, that the fund I was with in Dallas, I went down to Houston after that internship, did 2 years at EY in TAS, valuation Q of E, and then joined a small energy fund as employee number 1 to help do upstream oil and gas M&A, build a portfolio around land, real estate, and upstream oil and gas assets in Houston. Did that for 8 years. All the outreach there was proprietary. It was a lot of fun. No banks involved, just going straight to landowners and energy asset owners. And was able to parlay that experience into a director role at a fund in Dallas, which had just raised their third fund and really needed to jumpstart BD and get out there and market. So spent about 3 years at that fund, which was long water opportunities based in Dallas, and really built out the infrastructure and the framework to scale the outreach to do manufacturing and industrials deals. Had a lot of success there, really enjoyed it. Decided to look to go up market a little over a year ago to do the same thing on a larger scale, and stumbled into the folks at Agellus. Same story here. I was going in as the first hire. So that's the kind of the commonality, is taking that risk and not being afraid to take a risk on a smaller and new fund and get in early. And it's been great with Agellus. As I said, the founders have great track records. We raised our debut fund quickly and have done 8 deals over the past 8 months, with a few more in the pipeline, built out the team to about 10 professionals. So the risks I would take, or you have to take risks, I should say, to get in the door early sometimes, to land in the right spot. That's the one of the ways it's worked for me to get there. Another way to get there, and it's a whole nother path, is to come in at a low level at a large fund and not be afraid to be BD person number 5, 6, or 7. As the function has grown in popularity, larger funds are over-indexing to it and building out small armies of BD professionals. And you can have a great career starting there, learning best practices, and then jumping to smaller funds where you have more outsized say and responsibility.
Yeah, I fully endorse that recommendation. I think it's a great way to break in is to learn from folks who have done it and join a team. It's interesting though. It seems like, and from my experience, it seems like taking a risk, being opportunistic to other opportunities is one of the most common ways to move up within the function, within the industry, changing firms. Do you have, would you agree with that? Do you have a viewpoint on why that is? Do you think that different PE firms just value business development in different ways?
I do. I think this is the gilded age for BD. It's driven by LPs. They see the imbalance between deal flow and dollars chasing deals. And so they will, if not mandate, strongly encourage new funds or funds that are returning to market to raise capital to institutionalize the BD function. That's driven a wave of BD hiring. I'm sure you're aware of that. That's your business. And I'm happy to see it as a BD professional. There is still a contingent of folks who think that either BD isn't on par with deal teams or BD is just a necessary evil. And that comes from kind of this antiquated ideology, in my view, that says, well, the best folks to be talking to bankers are the deal teams, the ones that are building the LBO models. I just don't think that's true, nor is it scalable for any fund. So as that continues to go away, you'll see more normalization with the way BD folks are comped and treated in firms. But it's never been better. And I'm personally ecstatic about the way BD folks are coming up in this market and being looked at as true standalone institutional forces.
Yeah, and even to push that even further, I think my take on it as I look forward is that my unsolicited take is that the future of this the future of private equity is actually led by sourcing, is actually led by business development, right? Because like when I look at putting this, for one place, you could put this in the macroeconomic context of AI and things you can automate, right? And like part of that is like you can either outsource it and or have an AI model actually build the financial model for you to today, right? And so like in that future where there are large parts of this industry that are either automated or tech enabled, where is humans placed and where do humans actually add the true value? And like a big part to me there is in this deep trust-filled human relationship building and thesis development, just like we've been talking about, right? And if you look at it from that lens, it's hard to make the argument that sourcing is not going to lead this, right? Especially with the proliferation of capital. Like the number one responsibility of a private equity firm and one of the number one hurdles ends up being getting money in the ground.
100%. There's no more insulated industry within the economy, I would argue, or most certainly private equity than BD. You can potentially automate functions away from modeling and due diligence. You can automate pre and post close items, accounting, et cetera. But what you can't automate is the relationship function that actually brings the deal to you. And it's never been more important because of the imbalance of dollars chasing, flat deal flow. You look back over the last couple of years, right? There's just such an imbalance that necessitates a real concerted effort and resources to get in front of bankers, brokers, founders to source your deals. And the folks that are doing that the best ultimately find and close the best companies and do the best for their shareholders.
You heard it right here. The bifurcation of the winners and losers comes from Deal Sourcing.
There you go.
3 guys on the Deal Sourcing podcast are bullish on BD.
Who would have thought?
Awesome. Hey, Justin, this has been great. I think awesome conversation. There's a lot of stuff that we probably could have spent a lot more time on. But yeah, I think it was pretty well-rounded. So
Justin, thank you, brother. Really appreciate it, man.